Scotland. Good morning, everyone, once again, and welcome to our weekly broadcast. Thursday, 10 a.m. once again, seems to keep coming around quicker and quicker. Thank you for joining us. And let me first of all introduce my co-host, Mr. John Corey.
Good day, how are you?
I'm very, very well. We're hearing plans that you're going to maybe move on to Hawaii from your current place in the US. Is that an aspiration or something that's on the horizon?
So it is an aspiration. My wife and I have been discussing, preferences for certain things. We do own property in Maui, so that's why I'm quite aware of what it'd be like to be in Maui, and I'm pushing for Hawaii. She's sort of thinking that's too far when it comes to commuting to London. I'm saying, look, we can fix that, so don't worry about it.
Yeah, technology's moving on. Air travel's getting faster, so we'll get there. And obviously delighted to welcome Andrew McDonald as our special guest today. Definitely not in Hawaii, definitely not in America, in
Sadly
the
not.
UK. Good morning, how are you?
Yes, I'm well, David. Thanks for having me. And no, it's slightly grey and drizzly outside, so certainly not Hawaii.
I can imagine.
I'm never hopeful.
Excellent. Okay, looking forward to hearing from you in a few minutes. So once again, our weekly broadcast, we do a quick overview of the market. We always have a special guest. We're going to hear from Andrew on a good topic. We talk about some of the projects that happen to be on our platform, and there's always some educational tips as we go through the day. So today is no different. A packed 30-minute podcast, broadcast, live session, call it whatever you want, but it's all about providing value and information. So property market update this week. John, I've went for, well, a topic you and I have talked a lot about in recent weeks, and certainly one that is in the conversations around the property industry. The article I've taken is from Property Tribes, sort of kind of well-known organization in the property world, and it's regarding the JVIP group situation, where it seems to be the company's gone into administration, potential losses of millions. Now, just as a caveat, I'm in no way saying that what the Property Tribes have said in the article is true. I'm not vouching for the validity of the information or anything that they have said. I also don't know the ins and outs of JVIP, so this is not in any way sort of indicating what that situation is. It's more, this is the topic in the news, John, and therefore it's worth having a conversation around this. So I know you're quite familiar with it, so I'll hand over to you. Yeah,
I mean, I led a presentation on this topic actually, and took the view, use it as an opportunity to think about lessons learned. One of the things that's well known, famous in the airline industry or aviation sector is they have checklists, and it's to fly planes safely. And every time there's an accident or an incident, they review the checklist and they make improvements. So I did a presentation, and it's available if people want to see it. Get in touch with me. But what questions should people be asking going forward when they're looking at opportunities, when they're trying to invest, particularly if they're a passive investor? How do you conduct due diligence? What could you spot? There was an example from this where the referring agents, there were people who were essentially paid or incentivized to refer investors to this organization. And there's a rumor, I don't have the facts, but there's a rumor they were paid up to 19%. So one of the things that the FCA cares about is that if there are agents getting paid on the front end to place money into projects, that all of that is disclosed, because the passive investors who are putting up the money need to know where the money's going, how much is actually going into the project, how much is being lost through the front end friction, and is that material to the success of the project? So JVIP, as a singular example, is possibly, I mean, if you take 19% off a development, and then you have some other costs, so the developer's starting at 80, say, percent of the money raised, and they have to take that haircut of that 20% loss off to then fund the work that they're trying to do. That's a stretch sometimes.
Mm-hmm. Yeah, and that's a really good point, just in terms of trying to make the numbers stack up. If there's that, I want to say high, but certainly a sizable chunk going to the introducing party, it definitely makes it more difficult. Now, I think from my point of view, I know very little about JVIP. I was aware they existed, but didn't know the ins and outs of them. What I find interesting in the article, John, was a comment that was made that the collapse of JVIP Group once again highlights the need for regulation of the wealth creation industry. And that's an ongoing discussion. How far should regulation go? And how much should the FCA be, if you like, straitjacketing retail investors and high net worth investors and financial promotion and all the factors of that. But when these big high profile things happen, it does drive that conversation, is there need for more regulation, or is it just there's always going to be either companies just happen to make bad decisions and go out of business, or in some cases there may be some misappropriation of funds?
Yeah, I think that's where well, you're quoting for a specific site, and I think you have to be careful about when you read things online, folks. You got to look at who wrote it. You got to look at their background. This idea that we want to regulate education because some people are inappropriately making decisions. I don't know. I would argue that if the FCA is going to be involved, they don't get involved with the education industry. That's a different thing. There's a department for education that's got nothing to do with wealth creation. It's just education. The point I think that's more salient, and this is what's in the FCA documentation from 2020 December, is we need transparency on where the funds are going when it comes to who's getting paid what to do what at the start. And this is one of the things you'll see on offers on the Leo crowdfunding site, because you guys adhere to it. You declare the charge that's paid to the Leo platform. You declare anything else so that people putting in their money can actually see up front. Now, it doesn't mean that people know how to run a project. It doesn't mean that COVID won't happen, or Ukraine won't happen, or supply chain problems. So there can still be business failures, plane crashes, whatever, when it comes to the project and the success. But you need to at least understand going in, where's the money going? So I like to tell people, follow the money, understand who's getting paid. And by the way, if someone's getting paid to be getting you into this investment, do you know how much they're getting paid? Do you know they're getting paid? And that's what the FCA is already made regulation. It's already written down in force. So I don't necessarily buy into this wealth creation solution.
Yeah, and it's difficult to enforce. There's another big challenge, Andrew, have you any comments on this? I don't know what you're kind of hearing through the circles you move in, but any observations?
Well, we were talking before the broadcast started about how many people may have invested on the platform. Don't know the precise figure, but there seems to be a lot, 70 plus, whatever the precise figure is, remains to be seen. But that tells me that people have possibly lost contact with the top brass there, and are maybe just following the money. And I think in times like this, it's important to really know who is taking care and stewardship of your money. And I suspect this will make people cautious. And there's the old adage of know, like, and trust, isn't there?
Yeah.
And all those three tropes will become more important now, I think, while people work out where to put their money, rather than just on a follow the crowd. It's knowing who's involved. Do you trust them? Do you like them? And perhaps in a venture like this, that sort of transparency was lost. But who knows? The truth will out soon, no doubt.
That's a good point. It tends to come out over time, and then people get a chance to see the whole story without any caveats.
As an educational thing, it does come out over time, but we have had Harlequin, we've had Dolphin, we've had London Capital Finance. There's a pattern to those. There's regulation to address that. And JVIP sort of follows that pattern in the sense that there was multiple layers and money that was put into the top layer, then was sent to the SVPs, the special purpose vehicles. The key here is you have to learn from the past events and improve your checklist, improve your process. Otherwise, you're going to get nailed. And classically, these things take 2 or 3 years to fully come out, and the money generally is lost, or at least some large percentage. So if you're going to benefit from any of this, you're going to have to pay attention to how it happened, what questions weren't asked, and then add that to your list of things to do going forward.
Mhm. Okay, yep. So let's move on again, just to finalize that again. In no way saying that everything your property tribes have said about the situation is true. We're not taking that at face value at all. We're just quoting the fact this has been reported in the press. And again, absolutely no sort of comment on the detail of JVIP. I don't know all the facts, so we're just literally commenting in general. So I suppose, John, the question for today actually leads in quite nicely. As a passive investor, what do you look for in companies offering investments into property?
Well, a couple of things. One is, and I've covered this a little, is, follow the money, figure out where all the friction is or where all the costs are, and do the numbers stack up? Well, first of all, do the numbers stack up? Can they even do the math? Second is follow the money and figure out, does it make sense? Who's getting paid? That also might tell you a little about why some people are more positive than others about a project. You need to look into the track record of the individuals, but I would suggest that take everything that you're presented and question it and say, well, what if it isn't true? So just because someone's declared it true, and they might actually mean it to be true, and it might be in their mind true, but challenge it and look at it and say, well, if this isn't true or this doesn't work like this, what's going to happen? You will get to the point where you cannot guarantee success. So therefore, you're going to have to say, well, I don't want to put all my money into one project. I want to put my money into a few projects, maybe same team or maybe different team. So that way you have some diversification across an area. Play to your strengths, do the concentration of, like, I know property development or planning or whatever it is that the projects are, so that you can ask better questions, and then take the view that planes still crash, dead kings are still found, things like that can disrupt the project. So you spread your money across a few projects. And when those rare events happen, and rare events do happen, Ukraine, COVID, whatever, that you're not going to get completely whacked because of that event. I mean, you cannot predict the future. So assume sometimes it will be stormy weather ahead.
Okay, thank you for that. I think some really good points. I hope that answers the question for the person that asked it. Okay, so before we move on to Andrew and our special guest, quick heads up on a couple of projects. Those of you that invested in the Becontree Avenue, the shareholder agreements have now been accepted by all the investors. Funds have transferred. The drawdown will probably be tomorrow on this, so you'll be getting correspondence early next week with Schedule 2, with all the details filled out of those who invested, and of course the signed shareholder agreement by AJ over at PLMD. So great to get that one finished off. Some really good news is that Avon Valley Apartments by Beaumont Homes, it is very, very close to paying out. This had been delayed a little bit for those who invested in this one due to the lender just being extremely slow on the legals. So the fundraiser, Ed Morgan, is now in funds from the lender. So he has the funds to pay back to the investors. It's with Sharon currently for review of the accounts of the SPV. And then we'll obviously send it out to all the shareholders for their review and then move to drawdown. So that will be our third project that we'll be paying back. So that's really good news. And actually I had a call this morning with Tina from Target 5. This one's been sort of bubbling along for a number of weeks and hasn't quite got the view deal. There have been some changes in the deal. They've changed lender. They've actually changed the plan in terms of the refurb they're going to do. So that's now been finalized, and this will be should be view date early next week is the plan. So again, looking forward to getting that one launched on the site. So absolutely delighted today to make an announcement. The announcement is that we have added a member to we call our advisory board. It's really an advisory team of people. They all bring different skill sets, different experiences. And it's great that I can lift the phone to them. We do meet once a quarter and just discuss the industry at large. And obviously we can lean on the expertise. So Mr. Andrew McDonald, delighted, Andrew, to welcome you on to the advisory board.
Thank you very much. No, it's a pleasure. It's a pleasure to join the team. Looking forward to the months and years ahead.
Yeah, absolutely fantastic. So we've obviously met. I think we initially met on Clubhouse from memory, although we've probably been to a couple of same events with Brendan Quinn. Yeah, so if I just take a moment, explain your background, what you do, your expertise, and then we'll get into a bit of Q&A with you to understand what's different cycles in property.
Okay, yep, thank you. So it's distilled up there from poached from LinkedIn. I've been in commercial property for 27 years. Trod the corporate board, so I've worked at 4 or 5 companies throughout that time, all up in the West End, practices of various sizes, from a large such as Capita to boutique brokerages. And primarily my background has been buying and selling commercial property investments for a range of high net worth institutions, high net worth individuals and property institutions. So it's a real sort of brokerage job with funds as my sort of core client base, based out of the City of London. And then 2 years ago, I took the decision, as a lot of agents do at my sort of vintage, that rather than just trying to buy and make these people money themselves, it's a good idea to dip in and be on the receiving end of the good deals. So I left my corporate world 2 years ago. I still run a commercial agency, Tandem Real Estate, which is down there. But alongside that, I run CREDO Living, which is a commercial conversion platform. And we're looking for defunct commercial property around the M25 for repurposing into residential at the moment. So that's what's keeping me springing out of bed. So that's a bit about me.
So fantastic. So what I wanted to do was just run through just some questions, really, just to give people an idea of, I suppose, a bit more about you, and they can then see the value you're going to bring, to us as an organization. Particularly, you're also going to be part of our project committee. So your commercial, obviously, knowledge and expertise is going to be very useful when we're analysing, particularly mixed-use conversions, whether it's a commercial downstairs. So that's going to be, again, really good to have you in on that. So first of all, why did you get involved in property? Why choose this career?
Good question. To kick off with, I often feel education is wasted on the young. And when I was leaving my A-levels to go to university, I had to make a decision. And I was pretty much guided by my father, who was a property developer. I didn't know what I wanted to do at that age. He seemed to enjoy it. It's a good mix of people and meetings and being out on site, and it's a good eclectic career. So it was just a natural thing for me to do, to follow in his footsteps, really. So I took a property degree at the age of 18, while I was probably making my mind up what I wanted to do with my life, and then I just fell into it after university. I qualified and then started my West End career straight away after that.
Excellent. Okay. And you've mentioned your father there, obviously having a significant influence. Any other sort of mentors or any books that you read that sort of you would point to as sort of helping in your journey?
I've had 4 bosses, I would say, since I started as a commercial agent, and I've learned something from each of them. I would not say any of them has been a perfect mentor by any imagination, or any stretch of the imagination, but I've been lucky to work with some strong personalities, both good and bad, and I've picked up some habits and some learnings from all of them. So I don't carry a mentor from my career, but there are numerous people who've made impressions upon me, and I've been impressed by the way they've conducted themselves and gone around their business, and I sort of use them as inspiration, really, for how I go about my business too. Okay.
I know, John, when I hear you talking about how you get into property, you refer to a book, I think, that you read. Is that my memory serve me right? That was kind of your trigger to look at property?
Yeah, my original connection that I think is seminal was I read a book called Nothing Down by Robert Allen, which was quite well known at the time, and it was about how to buy real estate and become an investor and not have to use any of your own money.
Yeah, there's some people who go down that route, and others like maybe just meet someone or someone they can look up to. So it's interesting. Both of those can play a part in people's journeys. You've probably already answered this one. In terms of conducting most of your business, is it sort of the West End, or is it extended beyond London?
Well, yeah, it has. It's been up and down the length and breadth of the UK, really. So I've bought and sold property from, I think the furthest north I've been is Dumfries in Scotland, and the furthest south I've been is Truro in Cornwall. So yeah, I probably know most regional accents quite well over 25 years. We try and do as much as possible as close to the West End, for a couple of reasons. The closer you are to London, as a general rule, the higher the value the property is, and obviously the higher value the property as in an agency capacity, it means larger fees, and also it's just within easy reach of home.
Two very good reasons.
Yeah. People get horses for courses, but people get seduced by the yield up north and live in the south of England, and they've got to make the decision whether they want to spend a day on the road to look at a property which may not suit. But each to their own, really. Do what works for you.
No, that's a very good point, actually. Very good point. Remember in the heyday of buy-to-lets, people in Northern Ireland were buying property in England, Bolton and places like that, and they're flying over to look at property and then flying back to help tenant it and repairs. And I used to scratch my head and going, but you can buy the same thing in Belfast that doesn't need all that travel and all the additional risk, I think, that goes with not being very near your asset. But as you say, for others it works well, and they find an area they like, and they're happy to do that model. So how are you? Different cycles. What I was keen to really get from you today, because what I've always found fascinating when I've met you and spent time and after events and stuff, is that you really do have an incredible knowledge, not just in your own sphere of the commercial, but I mean, you're very much a student. You're someone that likes to look at the detail, and you've obviously been around property for a while. You saw these cycles, you saw the crashes, the booms, the busts. So have you anything you've learned from that, Andrew? Anything you've taken away from that would be sort of beneficial or educational for the attendees?
It's as simple as saying property cycles are cycles, and they're really over 27 years that I've seen. I think I've seen most things, but until the next thing that comes up to surprise me. I mean, the big ones in my career were, the biggest one before COVID was the credit crunch of 2008. The 2001 cycle wasn't really particularly material, but the credit crunch in 2008, people thought that the financial world was ending. Retrenched into their bunkers with a tin hat on, and to a large part of the industry at that stage, it looked like it would never get out of it. But lo and behold, 2 years later, tin hat off, people feeling a bit more confident, and it is a herd mentality, really. As soon as some people see other people buying, they tend to feel confidence out of that, and the cycle continues again. So my view is that no matter how bad things are at any given time, there is going to be a better time. We don't know how long that's going to take necessarily, but you shouldn't necessarily be scared by being at the bottom of a cycle and thinking that the world is going to end. It will come back. It's just a period of time.
Quick comment.
Yeah, great. Yeah, I was going to bring you in, John.
It's fine. I'm not a fan of quote cycles, because some people say, oh, there's an 18-year cycle. It's like the data doesn't support that. But what's interesting is I like to joke with people. I say, look, property prices go up or down, whatever. You can look at the long-term average, but notice that people don't like to buy on sale. We rush to the stores, we rush online for sales, Black Friday sales at Amazon, whatever. But when property prices are low and everything's on sale, oh, no, I can't buy then. I got to wait till the prices go up. I have to wait till it feels safe. I want to pay full price or better, because they're buying this stuff on sale. That's such a bad idea. And it's like, well, what's the point? If you're supposed to be a market professional, do your homework, figure out if it's a deal, that one property is a deal. And if you buy it on sale, you're going to be really happy later. But no, people love to wait till the prices go back up.
Yeah, and that's so right. And you'll never judge when the market at its bottom or to buy, and it's very difficult to judge when it's at its peak in order to sell. Really, there's no harm buying close to the bottom when prices go down a bit further, they come back up, and there's no harm selling before it gets to its peak. Property is a long game. It's a 40-50 year career. And if you don't
that's the big point Andrew just said there, everybody. property is a long game. This is not a short-term trading thing. There's a lot of friction, buying and selling costs. So you don't think of it as I'll buy today, sell tomorrow. And generally that doesn't work as a strategy. There are very few ways to do it, but it occasionally works. So think of it as buying it for 10 years. Think of it in the longer term horizon. Look at the demographics. So play the long game if you're going to be in the property space. If you want to be a day trader, you should be trading other instruments, not property.
Yeah. Well, so someone just commented in the Q&A there that you know what's been said there is very similar to the stocks and crypto as well. You know, there some of the same principles apply to any investment as well as investment in property. But doing the homework obviously is absolutely critical, and the decision of buying at a low point or selling before it reaches the high point, that's just a business decision that you make. You just need to make sure it's an informed decision, and that you're making it because that's part of your strategy and what you want to do. So how are you then?
And there's also a slight twist in this where you can extract value from the asset in the form of rent, but also in the form of refinance. So you don't actually have to sell to start to realize some of the gains. So property is slightly unique in that way, that you can continue to own the asset and still take out a tremendous amount of value.
I can remember when I was doing buy-to-lets, like way back in like 2000, 2001, too. And when it came then to moving properties on, or someone offered you a property, I remember a guy once saying to me, he said, David, always try and leave a little bit of something in it for the next person. You know, as his way of saying, don't hold out necessarily to maximize every single sale you make. Don't be afraid to leave something in for the next person. And I thought that was a good comment on that. So Andrew, then before we sort of finish up, we're going to talk about your current model that you're doing, but you're obviously adjusting your strategy a little bit given the current climate. You want to just speak to that, and I'll probably just move you on to the next slide for you, and you can talk about it.
Yeah, and just referring back, sorry, I lost internet connection for a few seconds there, so if I've been in and out, but just referring back to what you say about leaving something in it for the next person, I think that is such a good point. If you're involved in a property transaction and you are really trying to nail the buyer to the ground, taking every single penny, the higher the chances of the deal aborting there is, when there's an issue. And I've seen deals abort just as the market is crashing. So you need to leave the person a reason to stick with the deal if it gets difficult.
Yeah,
and that quite often means not necessarily driving the very hardest deal. Just move on, keep rinse and repeat, move on, don't get bogged down, and just get some momentum. So yeah, no, I'd echo that's a good point. You need to leave something in it for the next person. But in terms of what our strategy is, I left corporate to dig into this sort of commercial conversion world before the new rules on permitted development came through. So I mean, I kind of foresaw it coming. I knew there's an oversupply of commercial property, especially retail in our town centres, and I thought the direction of travel was to ease up on planning conditions on those, which would facilitate residential development. It's no secret now that has happened, and because we're in such a visible world, it's an open secret, isn't it? Which is making those deals more difficult because of the level of competition. And I was speaking to a local agent over in Buckinghamshire last week or the week before, and asking him if they would sell a property which they had to let. And his response was, what's going on at the moment? So I'm getting a dozen inquiries a week on this kind of thing, and it's because people see it and hear it on Clubhouse and see it on YouTube. So it is difficult, and the changes to the permitted development aren't all rosy. With the biggest issue I see is that the property has to be vacant for 3 months before you can get PD through, and that is an issue. So there are two things I could do. I can either pivot my strategy or work harder at what I'm currently doing. And the latter is what I'm doing. I'm just working harder and smarter, trying to find other ways to find the deals, and really not trying to veer and chase shiny pennies at the moment. You know, we've got a competitive advantage because of my commercial agency background, where I'm able to find deals. But I think there's a danger in just trying to find or chase every new strategy and, you know, getting nowhere really. So, you know,
that's a great point, Andrew. Playing to your strengths and using your competitive advantage, so that when you're looking at things, you see things that others don't see because you're trained to look at it differently, and it allows you to see opportunities or walk away from situations because you can see things that it's not like you're clairvoyant. It's just that you're better trained.
Yeah, that's right. You know, I know where, you know, I know our high streets inside out, and if there's a vacant shop on our high street, I'll have a good idea as to whether it will relet and at what type of rent, without being soft soaped or flannelled by a commercial agent trying to get a deal done. So yeah, that is my commercial advantage. I know how to speak to commercial agents. I know how to put deals together. So
somewhat to tie in a point, there's a question from the audience about what do you think of people who trade essentially using auctions, where maybe they're buying, or they even just have a contract exchange that they bought through an agent, and now they're flipping it in the auction, or they're buying the auction then moving into a different auction. Any connection between spotting opportunities you could quickly trade in and out of?
From my point of view, it wouldn't suit my risk profile. And I know some people do it well. You've got to be prepared to be left holding the baby.
Yeah.
And fine, you know, if you've bought it, if you've got a contract on a property which you can turn and make a quick profit, great. But if you don't, are you happy to, you know, to hold that property and deal with the consequences of that?
Yes. And one guy I know that used to do this, I don't know if he still does, he just also said you have to take losses. You have to be willing to put it low enough that it will clear. And if you take a loss, you take a loss, but you're going to make up for that in volume. So you won't get everyone right. And he was definitely not interested in holding. So he would set his auction minimum at a level low enough that it would clear somehow. But that meant sometimes he goes, I think in his numbers, he was at 3% loss, or out of all his deals, 3% of the time he's taking a haircut to get it off his books.
Yeah, that's what makes property so fascinating, because people have different strategies and different risk appetites, don't they? That's really not for me. I like to be a bit more educated and strategic than that. But great, if somebody wants to make a career out of it, then all power to them.
Yeah, I think that's a really good point to finish on. Exactly that. That different strategies, different people, and if everyone did the same thing, then obviously we wouldn't have a business. So it's this diversity of strategy and diversity of opinion, which comes from obviously different skill sets, experiences, backgrounds, aspirations. All those things feed into why people decide what to do. So Andrew, absolutely fantastic having you on today. Thank you very much for that. This of course will be live on our YouTube channel as a recording. People can go back and see it. Quick reminder, if anyone hasn't as yet subscribed for our YouTube channel, please get on and press that subscribe button. That would be very much appreciated. So just wrapping up, Tuesday was International Women's Day, and we are planning next Thursday to have on a number of women who are involved in property and also have obviously affiliation to the platform. So I've already touched base with Tina Wenham from Target 5, with Susie Jenkins from the Old Woolen Mill project, a couple of investors. So we're going to have a panel, and John and I are going to host this next week, John, and
we are
pick the brains of some of the women who are very successful in the world of property. So someone give me Tina this, just to mention this stat first, John, before I let you finish. Tina mentioned this morning to me, I think it's 5% is the figure of women involved in construction in the UK, only 5%. So that's probably the first question next week, and get the feedback from them.
Yeah, I don't know why that is. I noticed at my monthly meeting, when we were in the room, you could see it easily. Women made like 40% of the room. There was quite what I thought was the normal percentage, which now sounds like a high percentage. I did a couple times talk to some females, and they said that it was a more open or welcoming environment. That's why they came to the meeting. And I don't think I was doing anything intentional to make it that way, but I don't see why there shouldn't be more women in the sector, and there's some very capable women, and I'm more than happy as an angel passive investor to back some of them because they can take care of business. So, and just so people get the point, we didn't do this on Tuesday because we're on Thursday, so therefore we couldn't do it on International Women's Day, but we will do it next week on Thursday.
Yeah, absolutely. And last, just a quick update is the fundraiser live bootcamp that we have been talking about for a few weeks. We actually made a decision at the end of last week that we're actually going to postpone that. There's been just some circumstances outside our control, and all things being equal, John and I feel it's best we're going to postpone it probably to end of May, beginning of June. But emails have gone out to all of you who had booked and paid for that. So if you check your inbox, check your spam in case it's bounced in there, and then you can come back to us there on that. But yeah, so it's postponed next week, but we'll definitely be doing it in end of May, June.
And yeah, and anybody that has a deal that they're working on, they would have been there and needing to get it sorted quick, reach out to us because we can make sure we can get you over the hurdle, whatever it is, so that you're not delayed.
Excellent. Thanks for that. Okay, everyone, thank you very much for today. Hope you enjoyed that. Really good topic, some really good feedback there from Andrew, some brilliant insights into his experience. And again, you can watch the recording on the YouTube channel. And then we'll see you again next Thursday with a good look at women in property. Talk to you all soon. Have a great Thursday and rest of the weekend.
Good to see you all. All right, take care.
Bye-bye.
Bye-bye.